Two people, same year, same $100,000. One puts it in an S&P 500 index fund and leaves it alone. The other uses it as a down payment on a $400,000 rental property. 30 years later, who has more money? The answer isn't what either of them expected, and it's not what the real estate gurus on YouTube or the stock market evangelists in the finance forums want you to believe. Because the truth is messier than either side admits. And if you make the wrong choice based on bad math, you're looking at 6 figures of difference, maybe 7 over the course of your investing life. So let's do this the honest way. No agenda. Just the actual numbers, the actual trade-offs. And by the end of this, you'll know exactly which one is better for your specific situation. Quick note before we get into it. I'm not your financial advisor, and nothing here is financial advice. This is data, history, and honest analysis, which is more than most people get. If this is the kind of content that actually helps you make smarter decisions with your money, subscribe and hit the notification bell. We do this every week. Now let's start with the foundation. The S&P 500 has delivered on average roughly 10% per year in nominal returns going all the way back to 1928. That's not a guess. That's nearly a century of compounding through world wars, recessions, pandemics, and every kind of financial catastrophe you can name. After adjusting for inflation, that number drops to about 7% real return annually, and that's still one of the most powerful compounding machines ever invented. Real estate on a national level has historically appreciated somewhere between 4 and 5% per year. The S&P CoreLogic Case-Shiller National Home Price Index, the most widely cited measure of U.S. home values, recorded a 3.9% annual gain for 2024. Over longer time horizons, 4 to 5% has been the reliable long-term average. So on paper, stocks win easily. 10% beats 5% every single time. But that's not the whole picture. Not even close. Here's where real estate does something stocks simply cannot do. It lets you use the bank's money to amplify your returns. When you put $100,000 into the S&P 500, you own $100,000 worth of stocks. When you put $100,000 down on a $400,000 house, you control $400,000 worth of real estate. That's a 4-to-1 leverage ratio, and it changes everything. Let's run the math on year one. If your $400,000 property appreciates at 5%, you've gained $20,000 in value, but you only put in $100,000 of your own money. That's a 20% return on your invested capital from a 5% appreciation rate. Meanwhile, your $100,000 in the S&P 500 at 10% grows to $110,000. A $10,000 gain. Still a great year, but the real estate investor just cleared $20,000 in property appreciation alone, before counting a single dollar of rental income. So why isn't everyone buying real estate? Because the math I just showed you was the best case version. And best case versions are where people get hurt. Let's talk about what real estate actually costs you. Because this is the part the seminars and the late night infomercials will never sit down and walk you through. Start with the 1% rule. Many real estate investors use it as a rough benchmark. Budget at least 1% of the property's purchase price every year just for maintenance and repairs. On a $400,000 house, that's $4,000 per year, minimum. Older properties can run 2%, that's $8,000 a year before you've paid a single mortgage payment. Then add property taxes. The national average property tax rate is around 1.1% of assessed value. On a $400,000 property, you're looking at roughly $4,400 per year. Insurance for a rental property runs $800 to $2,500 annually, depending on where you are and what you're covering. Vacancy. Plan for it. Industry standard is a 5% vacancy rate, meaning 1 month empty out of every 20. If you're renting the property for $2,000 a month, a vacant month plus turnaround costs can run you $5,000 to $7,000 when you factor in cleaning, advertising, and any repairs between tenants. Property management, if you're not doing it yourself, runs 8 to 12% of gross rent. On that same $2,000 a month property, that's $192 to $288 every single month, just for someone else to answer the tenant's calls. Add it all together. That $400,000 rental property, generating $24,000 a year in gross rent, could realistically net you $10,000 to $14,000 after expenses, and that's before your mortgage payment. Your $100,000 in index funds? No maintenance calls, no vacancies, no insurance premiums, no property manager taking a cut. You just log into your brokerage account and watch the balance. Now let's address the tax picture. Because this is one of the most legitimate arguments in real estate's favor, and most people either don't understand it or wildly overstate it. On the real estate side, you can deduct mortgage interest, you can deduct property taxes, you can depreciate the building's value over 27 and a half years, which creates a paper loss that can offset your rental income even when the property is cash flow positive. These are real advantages. The most powerful tool, though, is the 1031 exchange. When you sell an investment property and use the proceeds to buy another like-kind property within a specific window, 45 days to identify the new property, 180 days to close, the IRS lets you defer your capital gains tax. You can roll this over and over, building an ever larger real estate portfolio with money you would have owed the government. And here's the kicker. If you hold a property until death and leave it to your heirs, the step-up in basis rule wipes out all of that deferred gain. They inherit the property at its current market value. The tax bill disappears. That's not nothing. That's actually a generational wealth strategy. Stocks aren't without their own tax advantages, though. If you hold for more than a year, long-term capital gains rates are 0, 15, or 20% depending on your income, significantly lower than ordinary income rates. In a Roth IRA, your gains are tax-free forever. You can also tax loss harvest, selling losers to offset winners, which is something you simply cannot do with a house. The honest verdict on taxes: real estate has more tools, especially for high earners who own multiple properties. For the average investor building wealth through a 401k and brokerage account, the tax advantages are more comparable than most people realize. Let's talk about the one thing financial calculators never capture: liquidity. The S&P 500 is liquid. You can sell shares in about 3 seconds. You need cash fast, you've got it. You want to move money from a losing sector to something else? Done before lunch. Real estate is the opposite. Selling a property takes 30 to 90 days in a normal market, and in a down market, months longer. Closing costs eat 6 to 10% of the sale price. You can't sell a single bedroom when you need $10,000 in an emergency. You own the whole thing, or none of it. This matters more than people think. Forced sellers, people who have to liquidate real estate because life happened, almost always get worse prices. They sell at the wrong time. They absorb the full transaction cost. Illiquidity doesn't just slow you down, it can actively cost you. The stock investor who lost their job in 2020 could tap their brokerage account and stay afloat. The landlord with the mortgage, insurance, property taxes, and a tenant who stopped paying in the middle of a national eviction moratorium. That's a different kind of stress. And now the piece that nobody wants to admit: human psychology destroys returns in both asset classes, just in different ways. In stocks, the enemy is panic selling. The Dalbar Research Group has tracked investor behavior for decades. In 2024 alone, the S&P 500 returned 25%. The average equity investor earned just 16.5%. That gap, nearly 9 percentage points, came from people making emotional decisions, selling in dips, jumping back in late, chasing whatever was hot last quarter. The market delivered 25%. Behavior cost people almost a third of that return. The average equity investor has now underperformed the index for 15 consecutive years. Not because the market is rigged, because humans are wired to buy high and sell low when fear is running the show. Real estate has a different psychological trap. Because the price isn't updating every second on your phone screen, it feels more stable than it actually is. Owners convince themselves their property is worth more than it is. They hold losing properties too long because selling feels like failure. They ignore the maintenance costs that are quietly bleeding them dry. And they underestimate how exhausting the work of being a landlord actually is, until they're 11 years into it. Getting a call at 2 a.m. about a broken water heater. Both assets punish undisciplined investors, just in different ways. Let's come back to the two people we started with. $100,000 invested in an S&P 500 index fund, 10% average annual return, no fees beyond a 0.3% expense ratio on a basic ETF. After 30 years, that $100,000 becomes approximately $1.74 million. That's the math. That's the miracle of compounding. Now the rental property scenario. $100,000 down on a $400,000 house. The property appreciates at 4.5% per year, right in the historical average. After 30 years, the house is worth roughly $1.5 million. But remember, you were leveraged. You borrowed $300,000 to buy it. You also collected rent for 30 years, let's say $200 per month, in net cash flow after all expenses, which is actually a pretty optimistic number given insurance increases, maintenance, and vacancy. That's $72,000 net rental income over 30 years. All in, your real estate investment has generated roughly $1.27 million in equity, plus that $72,000 in income. Call it $1.35 million total. So over 30 years, stocks win by about $400,000. But here's what that comparison doesn't account for. If you used rent from the property to invest additional money every single month, even small amounts into stocks or other assets, you're stacking returns on top of returns. And if you used a 1031 exchange to trade up from that $400,000 property into a $700,000 property, and then a $1.2 million property, your leverage is compounding in a way no index fund can replicate. That's the real story. Neither asset wins in isolation. They win when deployed with strategy and discipline. So here's the honest answer, which is the one nobody in this debate wants to give you. Stocks are better if you want simplicity, liquidity, and maximum long-term compounding with minimal active management. If you're working a demanding job, don't have time to manage tenants, live in a high-cost market where rental yields are thin, or just don't want to deal with it, a consistent automated investment into a low-cost index fund will build substantial wealth over time. The math backs that up completely. Real estate is better if you're in a market where rents are strong relative to purchase prices. You're willing to actively manage the investment or have the margins to pay someone else to, and you plan to use leverage and 1031 exchanges strategically over time. In the right conditions, real estate's combination of appreciation, rental income, leverage, and tax advantages can absolutely outperform an index fund on a cash-on-cash return basis. The three things that actually determine which one is better for you. Your market. Rental yields vary dramatically by zip code, and a property that cash flows in Cleveland will destroy you in San Francisco. Your time. Real estate is a business, not a passive investment, and if you treat it like one, you'll win. If you don't, you'll bleed. And your temperament. Can you hold index funds through a 30% crash without selling? Can you handle a difficult tenant and a $12,000 HVAC replacement in the same month? Your honest answers to those questions matter more than any spreadsheet. The one thing that's almost always true, both camps, in every study of wealth, in every honest conversation about money, is that the investors who built real wealth didn't sit on the sidelines debating which one was theoretically superior. They picked one. They learned it deeply. They stayed disciplined. They let time do the work. The worst financial decision isn't stocks over real estate. It isn't real estate over stocks. It's paralysis. Waiting for the perfect moment that never arrives. Staying in a savings account earning 4% while inflation eats the other 3%. Convincing yourself you'll start investing when things settle down. Things never settle down. The best time to start was 10 years ago. The second best time is right now. So I want to hear from you. Are you a stocks person, a real estate person, or are you somewhere in the middle trying to figure it out? Drop it in the comments. I read every single one, and your answers genuinely shape what we cover next. If this broke it down in a way that actually made sense, hit the like button. It takes 2 seconds, and it helps other people who need this information find the channel. Share it with someone in your life who's stuck in this exact debate. And if you're not subscribed yet, do it now, because next week, we're getting into something I haven't seen anyone explain properly. The real reason most people who start investing in their 30s still end up broke at retirement, and what to do differently starting today. I'll see you in the next one.